Okay, so good morning, everyone. Welcome to the new week. This is the macro snapshot. We are Monday, February the 24th, 2025, recording this at about just after 7 o'clock on the Monday morning. Okay, so obviously the big news over the weekend was the German elections. There had been some, sort of interesting commentary around that. But the bottom line is that the market has taken it as a fairly positive result. What we can see here is that the Christian Democrats got about 28.6%, along with the other sort of centrist right parties. So that's not enough, obviously, to make a majority. The AfD, which is, of course, is the extreme right wing, that did pretty well, but as expected, about 21%. But no one wants to be in a coalition for them. So at this point, they're going to be sidelined. So really what the market was trying to figure out is, would all of the small parties gain enough? They needed a 5% threshold to get seats in parliament. And what we can see here is that the FDP, which is on the right wing, got 4.3, and the BSW only got 4.9, although they might want a recount. But the point is, both of those very small parties are less than 5%. So what that means is that the big, the sort of centrist bloc of the Christian Democrats and the Social Democrats, which, as you can see, he got about 16%, they will have enough, probably with the Greens, to form a coalition. They'll have more than 50%. And what that means is that the small extremist parties like the FDP and the BSW will not they won't be in parliament, and of course the extreme right, the AfD, will not be in parliament. So the market has basically taken that and said, okay, there's going to be a relatively quick formation of the coalition, and secondly, that this coalition will not be made of 4 or 5 small parties with very different ideological viewpoints fighting each other and being fractious, but it's going to be a relatively a center-right kind of coalition with a bit of input from the Social Democrats as the junior partner. So the point is that the market, let's have a look how the market reacted. The market is basically, pretty happy with this. If we look at, oops, sorry, I have to just change a couple of things here. If we look at, let's say, something like the euro initially did quite well, but what's interesting, just looking here, where's the euro? The euro. So the euro originally, this is the daily chart. You can see here that it popped, but as we can see, it's actually given back almost all its gains. So what the market seems to be telling us at this stage here on the Monday morning, at least, is that, okay, this is not the worst scenario, but the real business of sort of improving the German economy begins. And also the other issue here is that, remember that in order to change the fiscal brake policy, which means that there's they can't do a lot of spending, that the government requires a 2/3 majority in parliament, a 2/3 majority. And at this point, the biggest party got 28%. So they're still very far away from getting a 2/3 majority. And it looks as though they won't be able to do that. If that is the case, the likelihood of the fiscal brake being released and more government spending becomes, quite frankly, quite difficult. And therefore, you have to ask yourself whether the government can do enough fiscal stimulus to actually stimulate the German economy. So then we go all the way back before the election, and here we are with still, a relatively weak economy with not enough fiscal sort of stimulus, with the threat of Trump's tariffs overhanging. And that explains here why you see the Euro USD here had a quick pop and then dropped. If we look at it against the Japanese yen, going up a little bit, but still pretty weak. And so even against something, let's say, like Australian dollar here, interesting, just sort of popping up and coming back. So the euro having an initial pop, but not doing that well. Okay, so what about the stock market? The stock market, there was, a reasonable reaction. If we look at the Euro stocks, which is the top 50 all across Europe, you can see here that also had a pop, but again, that's given up most of the gains. So the European index there not doing super well. What has done well? You can see here the DAX up 67 basis points. So the DAX, which is the German index, of course, actually has been the outperformer. So it's outperformed the CAC 40 in France, the broader general Euro stocks. And so the German index, they're doing quite well. And that makes sense because, as we say, it's definitely not the worst case scenario in terms of result. And secondly, the Christian Democrats, if nothing else, are relatively pro-business. So the German stock market doing the best. And that's not surprising. Also not surprising is that the Bunds, let's have a look at the Bunds here. So you see here, let's just look at, let's say, the 2-year here. So this is the Schatz. So just coming off a little bit, and that's normal, a little bit of risk on and sort of, that risk premium being taken out. So we see the Schatz doing pretty well here. The Bobble, the 5-year, also coming down. and the 10-year, the Bund itself coming down. So that's pretty normal. But what's interesting in terms of the future of the German bond market is that it's a little bit ambiguous because if the debt brake cannot be change that law and more fiscal spending. Ultimately, that might be quite good for the bunds because that means less issuance essentially. So there's less issuance. That could be a positive. But again, that's going to be a discussion going on into the next few months. And probably at this point, the Scholz, the new German chancellor called Merz, I believe, Friedrich Merz, he is aiming to have the coalition in position by late April. So probably what's going to happen is that German domestic politics will not be the main driver of like the euro and the bond markets, going forward. There's going to be kind of a lot of horse trading. What the market will probably start refocusing on again is obviously going to be like the general economic situation and the threat of Trump tariffs. And of course, possible other issues with Russia and Ukraine and whatnot. Okay, so let's just now then look at some of the bigger pictures. I mean, what we saw on Friday, we had a bit of a sort of a risk-off kind of thing. And we can look at one chart. I'd just like to look at this one here, which is the ITOT divided by government. So this is the totality of stocks in the US ITOT divided by government, which is the totality of fixed income, of bonds. And what we can see here, big red candle, which is a pretty unusual reversal here, but a big underperformance here of the stocks versus the bonds. And what's interesting here is that it's kind of like a growth scare. And really what we're trying to figure out is the market just scared a little bit? We saw, some consumer sentiment numbers on Friday. We saw with the University of Michigan, they're a little bit lower. We saw some service PMIs coming in a little bit softer. We saw the retail sales coming in a little bit softer. So, some commentators are saying, aha, these are signs of the cracks in the real economy and that the labor market is weakening. And with Elon Musk and the Doge initiative that there's going to be 2, 3, 4, 500,000 jobs and sort of knock-on effects lost, especially in the Washington area, and that this is the beginning of a genuine slowdown in the US economy. So, but I don't know at this point if we've had strong and obvious and evident data which is showing a growth reduction, maybe a small slowdown, but maybe it's just more of a scare. And so but what we do have as real data, though, is actually sticky inflation. So we definitely have a situation where inflation is sticky or possibly even moving up a little bit. And we can look at a couple of charts here just to have a look at that. Let's have a look. Let's have a look at the inflation swaps and what the market is sort of pricing here. Whoops, sorry, I've got a lot of stuff up here. Crude oil. Sorry, guys, on my desktop. There's just like a lot of, I thought I had no, I don't have the inflation swaps. But I can bring that up for you. Sorry, I've got literally 20 things open here. So what I'm going to do is just quickly find the inflation swaps, which is here. So this will just give us a sense of where inflation is going according to the market. And as we can see very shortly, you can see that it is remaining sticky. It's stopped going down, which it had been doing. And then even this is the 1 year, which is the white one. Actually, over the last few days had been going up. It came off a little bit on Friday, but essentially remaining very, very sticky here. And also, so what we're getting a situation is possibly is, I don't want to say stagflation, but almost like a stagflationary sort of feeling, this idea that inflation is not really going down and that the economy may be starting to show a few cracks here. So that's where the market's going down. And maybe that explains why the stock market went down. But just getting back again to that chart, what we're going to see here on the ITOT over government is, I just want you guys to notice here, it's just sort of interesting to see that this is where Trump came in on the 5th of November. And you see there was a gap upwards. So we're getting down towards testing that, maybe the 100-day moving average, or even down to the 200-day moving average, maybe something around about 5.6 or so. So let's keep an eye on this chart. And what we're seeing with a lot of charts is that they are coming back down to that sort of period where the elections happened, about the 5th or 6th of November. And basically, what's this signaling to me is that the market is starting to get a little bit, I don't know, nervous or impatient about the Trump administration. Is it delivering the pro-growth policies it promised to, the tax cuts, the deregulation. For sure, we have, sort of Elon Musk doing, some, with a chainsaw and everything like this. But there's still a lot of uncertainty about tariffs, and I think the market is starting to lose patience a little bit and getting a little bit nervous, and that's why it's coming down to test a lot of key levels. But what's interesting, though, if we do have this situation that it's just a growth scare as opposed to a genuine growth reduction. Why do we know that? We know that because if we look at, let's say, the bond market, and I'm just going to go back here into my regular stuff here. So let's say, for example, we look at like the 2-year the spread, which I'll look at in a second. This is the spread here, just in the CME website. So you've got the yield here on the future, so the 2s going all the way out to the 30s. And if you actually compare that to, let's say, like a day ago, and I'll just apply this here, we can see that the shift has been, a little bit at the front end, but essentially it's been essentially parallel. So the yields have come down a little bit over the last, sort of day or two of trading session. But as you can see here, they've come down at more or less the same rate, a little more at the front end, but essentially a parallel shift. And what that is telling us, if you have a parallel shift, and I'm going to look at, let's say, the 2s, 10s here. Just going to bring that up, the 2s, 10s. You can see here that the yield curve itself has not actually steepened a lot. Imagine this scenario where the market genuinely thought the US economy was coming down in terms of economic performance. What would be the corollary of that? The corollary of that would be that the Fed would be cutting, the market would think that the Fed would be cutting at the front end quite aggressively. So that would cause the front end yields to come down much stronger and would cause a steepening. But what we've had here is essentially the yield curve not doing much at all, just trading in a range. On the other hand, if the market thought that so the growth was really collapsing, we would probably see the back end yields coming down a little bit, and that would cause a sort of a flattening in that kind of scenario. Okay, but we're seeing neither, and this is telling me that the market's just a little bit confused and saying, well, hey, maybe there's a growth scare, there's the potential for a growth reduction, but what we do know is that inflation is not really going away fast, which means that the Fed is not going to be cutting aggressively anytime soon. So what that means, though, is that if we go and just look at what's happening with the Fed, we can get just a little bit of repricing for the Fed, but we're not going to get sort of massive. We're not going to get massive repricing. So, for example, if you look here, this is the what's priced in by the markets for the December Fed meeting, which is a good sort of end of year metric. And you can see at the moment we've got about 45 basis points, so not even 2 cuts, almost 2 cuts priced in. Now, for sure, this is a 3-minute chart, so for sure we can go back to sort of Friday morning, and we can see here that there were only about 39, 40 basis points priced in, and now it went down, and which is more dovish, and now it's 44. So, yes, there was a 2 or 3 basis point repricing, but it's not like a 10 or a 12 basis point repricing. And so to put it all together, I think what the market was telling us on Friday was, we're still a bit concerned about inflation. We acknowledge that there's the potential for a bit of a slowdown, but we're not convinced that that's actually definitely happening yet. So the pricing for the Fed cuts are not really coming off very dramatically. And we'll see that if we look at something like the 2-year yield, which we can look at here. I'll just bring it up. Where's the 2 years? So we look at something like the 2-year yield here. And again, it's just been trading in a range. If the market generally thought the Fed would need to cut because of a very serious economic slowdown, we would probably be, down 10 or 20 basis points at this point. But really what we're doing, we're going up and down 4 or 5 basis points. And, finding it, it's difficult. On the other hand, it's not really particularly, the Fed's not going to be hiking. So we're probably going to be, around to this 441, 442 level as the top. And then maybe down a maximum of, around about down here, about 407, 408 basis points is probably what's going to be going down. Because, if we had fading growth, that's going to lead to inflation going down, but it's going to be a very, very slow process. So it's possible that that the economy is slowing slowly. It's possible that the employment situation is deteriorating slowly, and therefore growth slowly could be deteriorating. But the thing is, this is going to be something which is going to happen over a month or 2 or 3. So the Fed doesn't need to move dramatically and it's going to be a slow grind. Okay, so all we need to worry about is really just the odds, the percentages, the probability of cutting might go up and down a bit, might go up a little bit, but really, probably about 409, 410 is the maximum for the moment. And we see a similar kind of thing if we look at the 5 year, probably, down to maybe like 413 might be the lowest, which is the 200-day EMA here on the 5. And then if we look at the 10, maybe it's going to get maybe to 428, something like that, maybe down around here or so. Okay, so yeah, I think yields can come down a little bit, but it's going to be a slow deflationary kind of move rather than a very aggressive move. And so the thing is, the way we see that as well, it's interesting if we look at something like TIPS. So this is the inflation protected sort of ETF, which essentially is tracking real yields. And what you can see is that the TIPS are going pretty well. I mean, they're going quite strong. They might even be able to push up if we have like some kind of measured move here. We could see that the TIPS. Well, let me just grab this. The TIPS could move up to even up to about sort of 109, 110, 110 and a half and so. And the reason I'm saying that and why this is interesting is because what this seems to be telling us is that nominal yields are not really coming down fast. So you see, if everyone thought that inflation was coming down and the economy was collapsing, then nominal yields would come down very hard, and TIPS wouldn't do that well. But what we're seeing here is that the TIPS are doing quite well, and that is telling me that the market believes that real yields will stay relatively sort of elevated at this point, and you do need some protection against inflation. That's what it is, TIP, Treasury Inflation Protected bonds. So the TIPS are doing pretty well, and I think in this current environment where we have sticky inflation, that's possibly a pretty good place to be, and definitely the market is saying that, because the logic here is that if we do have a growth scare, okay, if you're a bit worried about the economy, sure, exit stocks, and that's what we saw on Friday a little bit. But if we have sticky inflation still, you're better to hold real yield, and that's what we're seeing here with the TIPS. Okay, but what we are also seeing though is that gold is doing very well, and that's an interesting one. But we'll get on to gold in a second. So what are the risks here? The risks here is that actually the Fed does start to cut, nominal yields collapse. But in order to see that, we're going to have to see a genuine sort of slowdown in the real economy, which we're not exactly getting at the moment. And this is all reflected if we go and have a look over the FX space. We can see something like the dollar index. It's interesting. I was speaking with a colleague and we're thinking that, is this sort of a bull flag? It looks a little choppier to me than a bull flag. And to be honest, what we're seeing here is that definitely Bessent and Trump, they do want the 10-year yield down. We're possibly seeing a little bit of a slowdown in the US economy. There's uncertainty because of the tariff situation. So until and unless we see the economy reaccelerating and tariffs, I mean, it could be possible for the US dollar to slip a little bit more. But then having said that, what are you going to go into? The Japanese yen for sure is interesting, but the euro we just discussed, not so sure. Australia is still got, for example, a tariff risk. And China is trying to pull its way out of a sort of a relatively strong sort of recession. But what's interesting here, looking at the dollar, if we just do a couple of sort of measurements here, we can see that just on a Fibonacci level here, it's got down to the 38% fib retracement here from this big move from sort of October. Pretty key level here. It's got some sort of horizontal support. Let's see, it's bounced a little bit, but it's not really a very convincing bounce at this point. Now, could it bounce a little bit? I think that's possible. It could, bounce a little bit. But again, we've got to go to these election levels, which is, around about down here, which would be a much more significant fib retracement level, either like a 50% or the 61.8 fib retracement at about 104 or 105. So I think there's definitely potential downside if you believe in that scenario, that we could go and retest just like the sort of the Trump election levels at, let's say, 105, 105, 17, something like that. Now, if we look at the euro, we just looked at the euro, but let's have another look at it again. Now, can it go up? Yeah, but listen, as I was saying earlier on, 105 or automatically just sort of rejected there. So you've got to say that this looks under pressure. The market wants to see more clarity in Germany, probably more fiscal stimulus in Germany, probably wants to see a resolution of the Russia-Ukraine situation, and probably wants to see that the tariff threat has been removed permanently. What is interesting is the Euro JPY. And we know that, the Bank of Japan is most probably going to be hiking once or even twice this year. But that's getting to almost like a quadruple bottom level. So it's difficult to be shorting at this level. But for sure, any sort of bounce up, I think would be pretty good. If we can get a bounce up to up here, I mean, that would be wonderful. It'd be like a gift. And then you got to say that, probably down to 155 levels is the next one on the table. If we can get down there, maybe even it'll do that, in this kind of cycle here. But any kind of bounce at, up to 158, 159 probably should be sold. And then you're going to get down to here. And then what's interesting is that, sort of in a future, could this even get down to, a much lower level, like one down here, like 150, 151? I think that's definitely a possible. The other thing which is interesting is look at the USD JPY. Again, that's under quite a lot of pressure. 151.60 is probably, a pretty important level. Sort of up here, you've got this kind of level up here. If it gets up here, that's probably an interesting level to be shorting again. And we'll see if we go all the way back. So you see this level about 151.60. If you go back here to November and here, it's pretty much the pivot level. That's a very important level there, which is the pivot. And anything above that is sort of risk on, so to speak, and anything below is, you could almost signal that as a risk off. So keep an eye on that level there, 151.60, 151.70, very, very important level. If it does get up there, I think, that would be a very attractive level to be shorting. Okay, let's have a quick look over at commodities. And again, guys, just getting back to this whole idea of tips and everything. If you look at, let's say, GLD, gold, which has been doing incredibly well. And what's interesting is that tip, as I say, has been doing well. But if you look here at, tip gold divided by tip, look at this incredible outperformance of gold over the real yield. And as you know, historically, gold does not do well in a situation where the real yields are going up. So what's very, very interesting and frankly quite difficult to understand and explain is that the gold has had a huge performance over the real yields, which is historically has not at all been the situation. And you have to go back here. You see, going back now for quite a long time, like a year or so. Now, is this central bank buying? Is this geopolitical risk? Is this the idea, that basically, the markets are losing faith in fiat currencies? They're all being debased. All that's possible, but what I do know is that gold is definitely doing very, very well. And if you let's look at it on a weeklies, and let's say perhaps we could put it on some Bollinger Bands, just to give another little bit of perspective here. I'll put some EMAs and some Bollinger Bands. You can see it's on the weeklies, it's closing above the weekly Bollinger Band. So it's extremely overbought, but hey, it can keep on going. As we all know, markets can keep on overextended and bankrupt us all. But as I say, you see here, it's unusual for it to close above the Bollinger Bands. And what I would say here, you see it's all above all the moving averages. Possibly what would be an interesting one is if it were to just retrace for whatever reason, maybe down to the middle Bollinger Band, which would be like 2.32 on this particular kind of sort of ratio here, or just putting it back again onto gold, which I'll put up. Let's have a look. Sorry, I'll put it just on the spot gold. You can see here on spot gold, that would correspond to something, around about 27.90. That would be a pretty attractive. You've got horizontal support there. That would be a nice fib retracement. Also, that Bollinger Band, the middle of the Bollinger Band, would be probably some pretty good support there. So 27.80, 27.90 would be, a great level to get in if possible. But if we're looking again at, let's look at GSG, which is the commodities broad sort of index here. And again, we can see here on the weeklies, going up a little bit, but not, not doing super well. The 23 level is pretty important here. If you look at that 23, you see all the way across, it's doing is that's the key level. So what I'm trying to say, if you look at that, and I'll just put it back on a daily, we look at commodities and I mean, it came off on Friday, but in general, it had been doing relatively well. So again, just getting back to this question of trying to decide whether we have a growth scare or a genuine slowdown in growth, which is different, you'd probably want to see the commodities really coming off harder because if there is a growth slowdown, surely then commodities would have to see the commodities coming down and would probably need to see, let's say on this particular ETF, the GSG, maybe down to something like, 2240 level being broken, 2230, something like that. Would have to get down a little bit more, which is possible in the next few days. And once it breaks that, then you can maybe say that, the commodities markets itself is weakening a little bit. And we saw the commitment of traders report, which came out on Friday, that, indeed, sort of gold has been sold a little bit, oil's been sold a little bit, but things like the grains are doing quite well. So we're still trying to watch that, but I would urge everyone to just to keep on watching the commodities space just to see that if the growth story is the growth slowdown story is genuine or not. But for sure, just finally, what I will say as well is that if we look at something like GLD, and let's divide it by GSG, we can see, so what we can see is that gold is definitely outperforming the rest of the commodity space. So gold is doing very, very well, outperforming tips. And also this is gold outperforming here also the other commodities. So definitely very, very strong. Okay, let's have a quick look at the equities here. And I'll just put it on the spot index on the SPY here. So I'll put it on the SPX if I can find it. Yeah. So if we look at the SPX here, as you guys can see here, hit the top of the Bollinger Bands and we had a down move. So for sure, we did get, a pretty serious down move. If we look at some broader stocks like Berkshire Hathaway or JP Morgan, these kind of bellwether stocks, they're also down a little bit. It does feel to me pretty weak. If the market does want to shake things up or shake things down a little bit. We only had a small retracement on Friday. I mean, it was like, what was it, 1.5, 1.8% or so. And that's really not going to stop anyone out. I mean, look at this very, very strong bull market. Really, if the market wants to stop people out, we're going to have a pretty serious shakedown of maybe like 4 or 5%, something like that. Now, that's what, 5.6% looks like going there. Actually, I'll just clean this up so we can see. There it's easier. So you can see that's what 5.6% looks like. And again, getting down to the Trump level. So you see that the Trump level, this is the Trump election here on Wednesday, the 6th of November, which would correspond on the SPX down to about 58.60, something like that. So that level, 58.60, 58.65 is a very key level. There's a bit of a gap fill there. There's also a gap fill there. So I think really what the market might want to do here is to close that gap. And if it does want to signal that there is a genuine concern about growth and nervousness, that a collapse of 4 or 5% would be much more appropriate than, let's say, just 1 or 2%. We need to test the bottom of the range, and that's it. So I'm just expecting that we could have some weaker price action. Again, it had plenty of opportunity. We had a triple top. It had plenty of opportunity on the stocks to break that triple top, which you guys can see here. It couldn't do that. Just poked its head above and sold off. Now, I know Friday was option expiry and there was some weird headline about potential second coronavirus and flu being discovered in Asia, et cetera, et cetera. But I think here what the market is basically saying, hey, Trump, we've given you the benefit of the doubt. We need to know what's going on with tariffs. We don't like tariffs. We want to know what's happening with your trade positions. We want the tax cuts extended. And we want some clarity about just what's happening with the deregulation and whatnot. And so it would not at all surprise me if over the next week or two we do get the S&P 500 coming down to these, let's call it the election levels, which on the SPX, as I say, about 58.60, 58.65 or so. Again, similar kind of situation. We look at the NASDAQ, look at that index. Again, I think something down to maybe 20,700-ish down around here. Would be similar kind of potential. Because at this point, you've got to say, why would the stocks go up? They need some kind of catalyst now. They have very high valuations. They're very expensive. We've seen money flowing into Europe. We've seen some money flowing into some of the Chinese stocks. The US stocks definitely need some of that. Okay, guys. So I'm just going to just quickly there. We looked at the Euro stocks again. Very, very overextended. I get it. Everyone's having, sort of a happy day because the German elections didn't go as badly as they could. But if you actually look at this, just, very, very overextended. It's above all the Bollinger Bands, whatnot. And so interesting to me that just finding it difficult to push higher. Just consolidating the last 2 or 3 days. We also see the Nikkei here just in a trading range, and we have the strong yen, which is probably not helping that. But again, if the Euro stocks come off and the US stocks come off, I do believe the Nikkei here could come back down through this trading range as well. Just finally, guys, just want to have a look at oil, which I would like to keep an eye on. We exited our position because just the price action was absolutely horrible there. So just want to go back here. I've got a couple of charts up here. Where are we? Oh, yeah, here we go. So if you look at oil here, this is just the curve. If you look at from a day ago, still very weak. If you look at compared to a week ago, you know, even below where it was a week ago. And look at the front of the curve there, pretty sort of flat, not doing much, prices going down. So oil is definitely weak. Waiting for resolution, Russia, China, waiting for some kind of better news on global economic situation. And just the price action here, sometimes you just have to recognize the price action here. Extremely weak. If you actually have a look here, in the last couple of months here, the rally has only had a one-day rally, sort of one day, 2 3 days whacked, 2 or 3 days hit, lower highs, lower lows. It's just there's just no energy in oil. I don't know that it's going to collapse into the 60s and the 50s, but at this point we just have this big downtrend, which is sort of holding it for the moment. But this is very weak price action, and if we look at the moving averages as well, you can see here that the moving averages, are pretty flat, not doing much. It's definitely not pointing particularly strongly upwards. So I think oil here, it's probably a bit of dead money just at the moment. Keep an eye on it, and that's that. Okay, guys, I'm going to leave it there because I've already spoken too long. But again, what I think we should be focusing on, we don't have a huge amount of data. We have a second reading on GDP for the US. We have core PCE at the end of this week. Of course, we have NVIDIA, which is going to be very important on Wednesday. We'll talk about that a bit more. We have NVIDIA earnings. What personally I'll be looking at is just to see how the stocks react today. I also want to look at the European markets and just to see whether this sort of bounce from the German election is sustained or whether that was, just a few hours. What we're trying to understand is the market trying to signal impatience with the Trump regime? And is it also putting onto that an idea that inflation is sticky and that maybe the real economy is starting to show some cracks, in which case we do have potentially a stagflationary scare. But as I say, in order to stop everyone out, you just have to look at something like the SPX here, and you see that really all of these longs here, in order to be stopped out and just to flush everything out, would probably have to go down to 5,700 or something like that, just to flush out all of these sort of weak longs. And just at that point, maybe the market will get clarity with the tax cuts being extended, with the tariff situation in a few weeks, and having flushed everyone out and broken all of those stops, triggered all of those stops, maybe the equity market could then go up. Also, keep in mind, and this is the final point, that the second half of February is historically a fairly weak, just of seasonality point of view, is fairly weak. So maybe that's also a bit of a seasonality issue here in the stocks. But I do believe there's definitely possibilities for more downside. Any kind of bounce here, if we do get any kind of bounce, we've got here on the ES, on the futures, you see just in this uptrend kind of holding here the 50-day moving average here. But it's a very weak bounce. And if this bounces up a little bit more to a good level, potentially like sort of 1 month expiry or put spreads could be kind of interesting, just waiting for positive clarity from the Trump administration. Okay, guys, as I say, I've spoken too much. I'll leave it there. I'll keep on talking all this week. So have a great day, have a great week, and see you soon.